up a Wyoming LLC. We make our investors members of the LLC. So I have 51% ownership of the LLC. We give 49% away to the investors. Um, if you don't know, we do our investment strategy is a little bit different, probably than everybody else that you're going to see out there. We do fractionalized notes. And what that means, I didn't invent that, by the way. I saw it in 2016 when I was buying a property, and I was using a hard money lender, and they went out and raised 1.5 million for purchase and rehab funds. And when I got the deed back, there was 86 investors on the deed, and so I'd never seen that before. And so with the Cindy and Shane, we're raising capital with all sorts of different people out there that have solo 401ks, self-directed IRAs, cash, 0% credit cards, infinite banking insurance policies, and home equity lines of credit. I think that's it, right? I think that's the gist of where we're getting capital from right now. But when we're doing fix and flips, we actually make the investors a member of the LLC. So in the event something ever happens to me, I get abducted by aliens or ran over by a car, the investors actually have ownership in the LLC that holds title of the property. We draft a note. And so, say for example, everybody brought different funds in here. Let's say Adrian brought 50,000 from a home equity. Damian brought 75,000 from a HELOC, or from a self-directed IRA. And Estrella brought 50,000 in cash. We would actually put all of those investors together on one note so everybody knows who the other person is. And, we want all of our investors to know who the other investors are on the deal. But we actually take that note, and then we have a personal guarantee. And then once we close escrow, we use a second escrow company to record a second trust deed on title. So the investors are protected 4 different ways. They're a member of the LLC. They have a note with a personal guarantee from me, and we also record a second trust deed on title. The reason why we structure it that way is because when you're out there working with investors and you got to raise, $450,000 or, $350,000 for gap funding on your deal, sometimes the operators or investors out there will get multiple investors together, but they're recording them in different lien positions, meaning that they'll raise 50 grand from somebody and put them in second lien position. Then they'll raise 100 from somebody else and put them in third, raise 75, and put them in fourth position. All of our lenders are in the exact same position. They're members of the LLC, which own the property. They have a note, personal guarantee, which all of the investors are on the same note. And then we record a second trust deed, so everybody's in the exact same lien position.
So, Mitch, why is it important that everybody be in the same lien position?
It's important. It's important to be in the same lien position because in the event that the operator something happens, right? The deal goes sideways. They don't finish the project. Whatever might happen, right? If you're in third, fourth lien position, everybody else in front of you is going to get paid before you do. So if everybody's in the second lien position, and also you're a member of the LLC that holds title to the property, in the event something happens, what if the operator passes away or something like that, right? And you have to go back and pick up the pieces. First of all, Shane and Cindy are also, members of the LLC as well. So if something does happen, they could step in, you could step in, you could finish the project, and you can actually, make sure that you get your money back and your return.
I guess when a deal goes sideways, if a deal goes sideways, there is a couple of exit strategies. And one of the ones that isn't talked about very often, but the way we kind of have this set up is the exit strategy with the biggest success is to finish the project, right? To be able to step in, take control of it, and get it completed so you get the biggest return when you sell the house. You can come in and, we do have enough equity in the deal that, hey, we could fire sale the house as is and kind of recoup everybody's funds as much as possible. but not make the full sale of the house, right? And then that's kind of, that foreclosure model, even though it's not a foreclosure, but that's kind of, hey, if the investors had to step in and fire sale out the house, but really what you want to be able to do is step in, take control of the project, get it to completion, get it across the finish line so you can sell it for the maximum amount and recoup your funds and hopefully still retain a profit. Um, and knock on wood, that never has to happen, right?
Yeah, exactly. I mean, I saw Damien, I think we met actually at Eddie Speed's real estate event. I saw your message out in there. And yeah, I think there probably was somebody in there that does it. It's not probably as common. A lot of people that are raising capital do it one of two ways. They either put people in multiple lien positions, or they make the members all members of the LLC, which we're already doing. The only difference is the way we're writing the LLCs up is we have an auto removal clause. So as soon as the investors are paid off, they're automatically removed from the LLC, and we can turn around once we sell the property. We'll turn around and reuse that LLC again.
So when you're fractionalizing the LLC, but there's multiple lenders with different dollar amounts, how does that
Yep.
work? If so they're all still in first lien position, right? So
So they're actually in second lien position. They're a member of the LLC, which means they have ownership to the title of the property itself, right? So they have ownership in the property. Um, the note is what spells out all the terms, and and explains like this investor is bringing this amount of money. We give 49% equity away to the investors. So if one investor brings 50 grand, somebody brings 75, somebody brings 100, based on the percentage that they fund of the total amount we need will determine what their equity position is on the actual LLC and the note. So we spell that out clearly.
So, so I understand because so they're getting equity and a lien position, correct?
And a personal guarantee.
And a personal guarantee. So they're getting equity, lien position, and personal guarantee. So I know that some PMLs, they'll just be on there for second lien, no equity, nothing, just second lien holder. This
Yep.
is second lien in an LLC with other members, equity and a personal guarantee. Love it. Okay. Love it. That was my question.
I love
Well,
your
I
hat
have a
today, Cindy.
question.
Thank you. It says, I don't even know what it says. This
country
one
music
says
and cocktails.
country music and cocktails. Yeah. Country music. I got it in Vegas. Actually, I got it in Vegas, Mitch. Oh, isn't that funny?
I
Got it in
love it.
Vegas. Yeah.
Somebody had a question, Damien?
Yeah, I have a question. So me as a lender, like I don't want ownership of the property. I rather stay as a lender.
Yep.
And so why would somebody want to have ownership of the property and have ownership in the note? Because you basically it's going to be a challenge if you want to foreclose on yourself, right?
No, I mean, the way the operating agreements are written out, in the event that I don't perform or something like that, the members could actually take over the LLC without foreclosing. So, or if something happened to me and I died or got hit by a train or whatever, and wasn't able to perform, the investors could actually take the LLC over without foreclosing, and we have the authority to make all the decisions for the property moving forward. It's kind of similar. I've done apartment syndications before. Apartment syndications are a little different because you have a LLC that holds title to the property, and then there's a separate management LLC, and then you have another LLC where all of the investors' shares are held in. And so you could do a version like this, but because we're not raising $10 million for an apartment building or $5 million, we're raising $450,000 for deals. So, but when we do creative finance deals, we don't make the members or the investors members of the LLC. They're actually just they have a note, personal guarantee, and a second deed of trust. The reason why we started putting everybody on the LLC is because we're raising capital with multiple people, and due to government regulations, the SAFE Act, title requirements. The hard money lenders and title want to know where all the money is coming from to make sure that it's not coming from, something illegal. So if I put everybody in here in on a note and I had all of you wire money to escrow, they want to know where the money came from. So if you're a member of the LLC, even though you're not personally guaranteeing, anything with the first trustee hard money lender or anything like that, it allows us to bring and raise capital and co-invest with multiple investors. And they don't care at that point where the funds come from because you're a member of the LLC.
But can't you also do that with the internote agreement and make everybody a first position lender? So if you had like 5 lenders come in and you could do 5 different notes and 5 different deed of trusts, and you can have the what is it called? The internote agreement where they're technically all in first position. That's one way. But then the other way too is that if you have someone that's raising capital, they can just create a wrap note and get a logical first and have all the other lenders fall in place under them, and that owner of the wrap note that's managing all that would manage like the process, of working with the owner upon default.
Well, the challenge is that, for example, I'm buying houses for $700,000 in Florida. So the hard money lenders that I'm getting, because of the volume of business I'm doing, I'm getting 8.25% to 8.5%. If you want to lend me 8.5%, let's go. But, so the hard money lender is going to be in first lien position because we get the best terms with them. It's, the interest rates are super low because of the volume of business that we do and the track record. In order to receive funds from everybody, and then also too, the lenders don't want to see the second trust deed recorded in the first escrow closing.
Yeah,
So
right.
like and so I've ran into all these scenarios. The reason why we do it this way is because literally I've been in the position where we had investors wire all the money into escrow and we didn't have them, we didn't have an operating amendment to the LLC docs. And then 15 minutes before we're getting ready to sign loan docs, the lender pulled out because the fund, we had 8 different investors that brought funds from all these different things. And the loan broker, even though I told them and we were crystal clear and transparent, he didn't tell the lending company that. And then at the last minute, they pulled out. Then we had to scramble, right, and close in 2 to 3 days and find, the other lender. So, a lot of it is by, trial and error. And this has been the most common way for us to be able to work with the hard money lenders, make sure that our private money lenders are protected, and then, kind of do it that way. Because also too, like I'm not doing 1 or 2 deals. I'm doing, I closed 10 deals this month. We're doing multiple properties, with the lending terms that I'm getting from the lenders that I have are direct to Wall Street. And so, we're going to be doing a whole volume of properties. So we have to have systems that are replicatable every single time. And we also, we want to take good care of our investors, right? We want to make sure, we have a lot of investors that are not as seasoned as you, have not been to Eddie Speed and all these different programs, right, that I've been to. I mean, I think that's where we met at. And so,
Yeah.
we have a lot of people that just, they work W-2s, they're nurses, they're engineers, they're stay-at-home moms. And, we want to make sure that we keep it simple for them and keep it consistent and, show them like how they're protected. If that makes sense. Anybody else have any questions? This is what I tell my team every day. Anybody have questions, comments, concerns, grievances, blessings? Lay them out. What do you got?
I think there's some in the chat here.
Is there? All
I
right,
think
let's
we got
go.
does having a JV agreement help?
Okay, so those are the 2 different forms of investors, right? When you have it's not really a JV agreement. It's a note with a fixed interest rate. Usually when you're going to do a joint venture agreement, you're giving up equity and there's not usually going to be a fixed interest rate. We're doing fixed interest rates, right? we're paying our investors double-digit returns upfront at the close of escrow. That's probably something else you're not going to see very common, because a lot of people, I didn't invent this stuff either. It's just stuff that I've learned over the years. The fractional note I learned in 2016. As far as like prepaying investors up front, I learned that from a real estate educator in San Diego probably about 12 years ago, 13 years ago. His name's Bruce Norris. He was actually out there in San Diego. He's in Florida now. I hope I run into him sometime. But that's who I learned it from. I went to AREA, and he would constantly say, "Hey, look, you can pay investors 3 different ways. You can prepay them 4 different ways. You can do a JV agreement, or you can pay them interest. When you pay interest, you can either prepay your investors up front, you could do monthly payments, or you can pay them at the end of the deal." I choose to prepay everybody up front because I'm gonna pay no matter what. And if I just pay everybody up front, I don't have to worry, about that part. It's already taken care of. All we got to do is perform, and then pay the investors off at the maturity of the loan.
That's
And
a
they don't
great
have to
idea.
worry about it either. That's one of the things that we've learned over the many private money lending deals that we've done that have monthly payments, is there is a little bit of tension, stress there, waiting for the private money lender the 30th. Am I going to get the funds at the end of their way? Especially if they're paying against the HELOC as well, right? So they know they have to make a
Yep.
payment. So they're waiting for your check to come in to make sure that they can pay their bill. If paid all
Wait,
up front,
you know what's great about for sorry, Shane, I always interrupt Shane.
you
It's my
always
it's I do, but I just because I have it in my brain. So you know what's great about this paying up front? So say you put 100K in, right? You're getting a 16% flat fee. What I did was I took my interest that Mitch paid me and I compounded it and sent it out again.
Exactly.
That is the best way to do it, is compounding.
Oh yeah,
Compounding.
that's a great idea.
Yeah.
Yeah.
But Damian, there was something I want, you said previously that you didn't want to have equity. But I'll tell you something, when you have to foreclose and you have to wait because you don't have any equity, it's a pain in the butt. The best position is when Mitch does give up equity, because if you don't have to foreclose, you can just take over the property immediately. Like if
But
you're
what if
yeah.
I don't want the property?
I
What
well
if I
then you
just
can
want to be the
sell
lender
it.
and I don't
But then you can
want to inherit that mess, right?
Well, you can sell it. You can at least sell it without foreclosing. You know how long it takes to foreclose on a property? Like
Well, it
it
depends what
takes,
state.
well, it
Like
depends on what
Georgia,
state,
Texas,
but
they're like very fast. But if you're in Jersey, it
uh,
takes forever.
well, New Jersey. But yeah, but I'm just saying it still takes, I mean, it took Shane a while now just to get a freaking tenant out of Dallas. So
Yeah, but this way you're not getting violations from the city, cease and desist orders from the city. There's no insurance thing. If there's somebody goes in and lights a fire, you're not responsible. You don't have to evict tenants. Like
well,
that's
I
why I'd
think
rather stay
having
on as just solely a lender,
yeah,
and
uh,
just if you try to do the foreclosure and you also are the borrower and the lender, it's probably pretty tough to go through that whole process because you really can't foreclose on yourself. You know what I mean?
I've never been,
uh,
you know what? I've never been foforeclosed on yet, and I've
neither
never
have
won a
I, so
billion
I
dollar
don't know.
lottery.
yeah,
So I
knock
don't
on
know.
wood.
You know
I don't
me, I
know
don't want to
either.
get started with that now either, but yeah.
I do know that I do know that in some states the foreclosure process is like a year. I mean, I can tell you the
Like
people behind
California.
me. Yeah, they could be in Arizona. These people were living in their house for 2 years before they got foreclosed on.
Yeah.
So, I mean,
Yeah.
that's why I would rather have that property and take it like I'll sell it instead of sitting there and trying to get it foreclosed on.
Yeah, but you
But
might be
that's just
getting it
my
in
two
a
cents.
position where it's like you have to go out to Indiana, someplace you don't know, evict a tenant, find a contractor there, all these unknowns that you don't have to do if you're just solely a lender on it. That's why I would just probably stay a lender if it's not in my market that I know and I have people there. And I wouldn't want
Yeah.
equity personally in the property itself. And if I ever did want like a profit share, I would just put the profit share in the note itself and not have ownership in the property.
I mean, we could always structure it. Everybody's a little different on, what they're looking for. we have such a variation of deals, that, I mean, we're operating in 10 states right now. We own properties in 10 states. Primarily right now, I just moved to Florida because of the opportunity we have here. We're buying houses for 40 to 50 cents on the dollar. You know what I
Nice.
mean? And these are waterfront properties with boat docks that you can walk to the beach. You know what I mean? And so the reason why I'm doing it is because I haven't seen an opportunity like this since 2014 when we had short sales and REOs and all that kind of stuff. We had a black swan event, but a 100-year storm that hit properties that have never been flooded before. And I know there's a lot of fear, when people get nervous, they're talking about Florida and hurricanes and that kind of stuff. But and everybody thinks, oh, you can't get insurance and you can't do all these different things. We've already figured out how to, like, you can assume someone's flood policy in Florida, you know?
Mm.
I bought a house today where, and this is the first time I did this. It was on seller financing. We're closing tomorrow. And a really good friend of mine gave me a land trust attorney. We actually set up a land trust. The person bought the house 25 years ago. We set up a land trust, and I bought the land trust with the property in it, and we retained their tax benefits. And so when we calculated it out,
that's sweet.
my taxes was going to be 20,000 a year. It's a $1.2 million house. My property taxes is $8,440, the exact same amount that they're paying.
Nice.
You
That's
know,
awesome.
yeah, and so, I mean, we're using top attorneys, top escrow companies, even when we're buying deals. Like now, we actually ask for a title and escrow every single time because we work with an escrow officer and title company, and then we have a separate escrow and attorney. We have to work with people that are investor friendly, especially when we're raising capital like this and we have multiple investors. And, so we work with specific companies that just know what they're doing, down to the title company, the escrow officer, the attorneys, if it's, we're doing a land trust or something like that.
There are a lot of people that are in Florida that are saying that they're that they try to get these properties free and clear, and then they don't
Mhm.
get insurance on them at all.
I
And
think
they
in
save the
more,
cost that way, investors that rent out these properties. And they're and I hope they have good reserves, but like that's one of the things that they're playing, and they're moving all their they're trying to get IRA money for properties, say in like Georgia, Atlanta area, and then paying off all the ones that are in Florida. And so they're free and clear in Florida, so they don't have to get the insurance down there.
so that is a very interesting topic, and I'm
And
glad you brought it up.
I don't want to be a lender on that house. No
Yeah,
insurance.
for a lender, that's
Yeah.
not a good idea.
Yeah,
But
free and clear means there's no lender, but yes.
Well, that's actually what happened in St. Pete Beach, Treasure Island. A lot of these homes were owned free and clear, or they were inherited by the parents, right, that already paid them off. So a lot of people had the houses paid off and they were self-insuring, meaning that, hey, we haven't had a hurricane here in 10, 20 years. So they didn't pay insurance for 10 or 20 years. And then all of a sudden they had a storm, right? So
or
for
two.
us, yeah, two back to back in 3 weeks, right? And so one of the things though too is that we're also getting surveys with elevation certifications on the actual properties. So every time we buy a property, we're getting escrow to get a survey, and we're doing elevation certs. We send out for property insurance immediately because we want to know what the coverages are, and they're going to tell you right up front if that house has ever been flooded. So all the houses we've bought in so far have never been flooded before.
Mhm.
And because we're buying in specific areas, right? There's certain parts of like St. Petersburg and Short Acres. There's some houses have been, flooded 2, 3, 4 times. If we can't get insurance on the house, we're just not going to buy it, right? It should probably be scraped and rebuilt. The ones that we're targeting are very specific. It was a 100-year storm. The houses we're buying have only been flooded one time, and it was last year. And then there's some precautions too that we're taking. I grew up in fire and water restoration. So my family's been in fire water restoration for 35 years. I've been doing it since I was 11 years old. I'm 50 now.
Wow.
So I've seen a lot of different scenarios, when it comes to like flooding and, how do you do water remediation, mold remediation, primering, all that kind of stuff. A lot of the houses that we're buying, in my opinion, it is the perfect way to buy a house because all the cabinets are removed, the bathrooms have been demoed, the drywall's cut up to 4 feet. I literally could see everything that's wrong inside the walls,
Yeah,
which
right.
is very rare, right? When we're out buying properties as investors, you can never see any of this kind of stuff, right? You're just assuming, the house is built in the 50s and 60s. I already know the 2x4s behind the shower are rotted out, right? And there's probably water damage and termites and everything else. We're able to see everything. And then also too, um, you got to have really good contractors too. I only use licensed contractors. This is something else too, right? When you're out investing with people, find out, are they pulling building permits? Are they using licensed contractors? We're pulling building permits on every single house and we're using licensed contractors because a lot of people want to go out. And I'm not saying I've done it in the past when I started out in the early days. Hey, we're all trying to get things done as cheap as possible and use these flip crews and you'll lose your mind working with, some of the people out there. And also too, like at the end of the day, you know, we don't want to have a problem in the future, right? When we go to sell the property and they get a home inspection and, find a bunch of things that weren't done correctly, so by using licensed contractors, I can hold them accountable, because at the end of the day, I want to protect my investors. My investors are my partners. And, we want to build long-term relationships with people that we can do this over and over and over with. And funny enough, I have multiple partners that have flipped one to three houses, and they're like, "Yeah, I did it. I'd rather work with you." You know what I mean? Because it takes a full army. I have 17 people on my team, plus Shane and Cindy, right? So you've got 19 people that are actively working on multiple pieces of the puzzle. I'm not doing it all by myself. We have a full acquisition team that analyzes hundreds of properties every week in order to find the deals that we buy. We have a full-time property preservation team that handles utilities, landscaping, pools, repairs, maintenance, contractors. We're always looking for new vendors. We have a full-time disposition team that, works to market and rent the properties, show them leases, background credit checks, housing authority section 8 on the rental side, and then also working, to find top real estate agents in the markets that we're selling that are investor friendly, and can actually sell properties in 60 to 90 days. And then uh, we have a full transaction coordination team. We have 4 full-time transaction coordinators because there's so many moving parts with escrow title. You're talking about 8 to 10 investors per deal. We had 80 plus investors last month for the deals that we're funding, right? There's a lot of communication that we got to do. And, we're working with home equity lines of credit. We're working with self-directed IRAs. Shane, who's our favorite IRA company? I probably shouldn't even say that.
Yeah, so we use John Park, and
Mm-hmm.
he's with PGI, and just fabulous guy. So I'll drop his link here in the side chat if anybody needs reach out to him, schedule a meeting. But he'll set up a self-directed checkbook control
That's
IRA.
better.
Yeah, so having that checkbook control makes all the difference. As we've seen recently, we've had some custodial accounts who say they're fast and easy to work with, but have delayed projects by weeks getting
Yep.
funds over. So having that checkbook control is so much faster, so much easier.
But the
Yeah.
downside with the checkbook control though is like you're at risk with making investments that could be, taxed and stuff like that. So having that check in there, I use Advanta and the only way you can do checkbook control is if you start an LLC that's owned by the IRA itself, and then you can get checkbook control through there. But they specifically don't allow that for that reason. They don't want the investors to just be going out there like doing things willy-nilly, and they want to inspect like the documents, the notes, and the mortgages to make sure that everything is conforming, and all the investments to make sure that they're conforming to what people can invest in. So there's a good side to that, and there's a downside to that. So
Yep, exactly. There's a good side to that, and there's a downside to that. And we do want everybody to be smart with their investments. Make sure you understand what you're getting into. That custodian account is a check for that, right? They are another person that's there. That's one option, but make sure that you're getting through your deals in a timely fashion.
Can I just interject with, sorry, just because I know a lot about these self-directed and custodian. So just because I learned this from John Park, like some of those custodians, like Equity Trust, like we hate them, but they I know we hate them. We hate them. How many deals have they? I mean, this is like their fifth deal, Mitch, that they just delay. But anyways, those custodians, they don't know, they're just another person. They don't know, they're like given a course and they're supposed to, this is what you're supposed to look for. I mean, they're not a financial advisor whatsoever. So just be aware that those bigger companies are those custodians, and those people leave. Like, I mean, I can't even tell you, it's like a customer service and then you get to a different person every time. So just if you're going to use a custodian, go to a smaller company that has a custodian that knows what they're doing. If not, you might as well just do it yourself. That's my 2 cents.
like, I don't know, I'm surprised that there's problems with Equity Trust. That's the one that Jeff Watson's on the board of, right?
Oh my God. Don't even get me started.
Yeah,
We'll
don't
be
get me
here for
started
hours.
either. If I brought my team in here and we talked about all the scenarios that we go through daily with Equity Trust, it's like, yeah,
Oh,
they
wow.
they are
Right.
the slowest company out there without
This
question.
is in
And
Procopia
it
Court,
literally, I mean,
right?
we've had to take 4 weeks
Oh, it is.
for them to actually fund it, and then they wired it to the wrong escrow company, and then they had to get the funds back, and then it took another week of review. It's just, yeah, there's a lot of them out there. I mean, at the end of the day, you got to make the decision that's best for you. If you're using self-directed IRAs, get opinions though. Like, ask the questions. How much are their fees? What's their processing timeline to actually get your money deployed? Um, it's typically going to be 10 business days minimum when you're working with an equity or a self-directed IRA. Because they got it, like you said, there's a lot of moving parts too. And when you have multiple investors in a deal, and there's if there's only one person that hasn't a self-directed IRA and they came in the 11th hour, the deal's not going to close on time. We've had to get extensions and, because they want to see the deed. They're going to look at the note, but they want to see the deed from title. And so, when we're raising capital, we have 7 or 8 or 9 or 10 investors. We have to have all of the funding for the entire project in order to get the deed to send it to Equity Trust or one of the other IRA companies. So, and this is just from experience, right? Because we're doing this like day in and day out and dealing with all the different things and moving parts. But yeah, it's the check writing authority. I mean, you definitely want to talk to your CPA, right? Like, hey, I have check writing authority. If I write the check this way, is there going to be a problem? Most of the stuff that has to do with self-directed IRAs, you cannot invest in your own property. It's better to invest in someone else's. And even if you invested in your own property, you cannot physically go there and do any work, not even put a light bulb in, because that will violate the the IRS tax guidelines, and you will get a tax bill for that. So essentially, it's better to go, find somebody that like, and trust, and that has reputations, been in the business for a long time, and invest in their deal. If I had a self-directed IRA right now, I would just go invest in your deal. I wouldn't even try to put it in one of the deals that I'm doing because I don't want to cross that line with the IRS. I'm not afraid of a lot of things. The IRS is probably one of them, right? none of us want to pay more taxes than what we need to. And, you know, you don't want to get audited at the end of the day and have to deal with a bunch of problems. So any questions? Anybody else have any questions out there about, you know, how investors are protected? You know, and the thing is you guys can always, if you come up with questions later on, you can always send those over to Shane and Cindy. We're always available. We're doing these almost every single night right now. We were doing it last night. You know, we're here to answer questions. I dropped that link down in there. That is the actual company that I use to set up LLCs every week. The reason why I like them, and they're not paying me by any stretch, I could tell you that. I've never even talked to them. My team's actually doing most of it. It's because we can set up an LLC in the morning, and 99% of the time, I'll have the LLC docs back within 4 hours with operating agreement and an EIN for like $300. It
Yeah,
doesn't get any simpler than that. And we've set up several, you know.
Mitch, Adrian asked here, out of those 10 deals that you talked about closing in a month, what percentage of those closed fully executed? All the PMLs get paid back, no extensions, no delays, no issues. You know, so kind of what is that batting average that you have on deals?
Okay, so one of the things is we prepay the investors up front. So the interest is already paid up front. We have it specifically written in the note. For some reason, if we go a week or two past the maturity date, first of all, we're going to communicate. We're going to tell you, hey, the maturity date's coming up. If we've, you know, finished the project, if we've had a delay, or, you know, it's on the market, whatever it might be, we're always going to communicate with the investors and ask them if they would be interested in extending on a monthly basis with monthly interest payments paid. Most of the time, if we needed another 30 or 60 days, even on a fractional note, I would say most of the investors would, you know, do a 1 or 2 month extension because we're going to pay them the interest every month. I'm not going to say we haven't ever gone past a maturity date before. This is real estate. But one thing is we're always going to communicate, and we'll either give you the interest. And sometimes, like I've had people that had emergency, right? Like they had a family emergency. I've had somebody have a family emergency in the middle of a deal when we had a 6 month term with them, and they really needed the funds back. And guess what? I paid them off because they needed it. They had a family emergency. There was something going on, right? So communication is really big. We do monthly updates for our investors the first Monday of every month. And we're always going to be transparent and tell you exactly what's going on with the property. If we had a delay with, you know, getting building permits or, you know, something, you know, whether it was a rental property or a flip, we always want to tell you exactly what's going on because this is real life, right? And sometimes it goes great. It's very smooth. Everything is, you know, on track, no issues. Sometimes you have, you know, delays with the building department, the city. Sometimes you got to fire your contractor. You know, these are just real things that happen. But, you know, being transparent, telling people exactly what's going on, and then, you know, keeping everybody informed. So we got about 2 minutes left.
All right. Well, thanks, Mitch, for
Yeah,
that. We
and
do
thank you guys.
appreciate it.
Thank you guys for asking. You know, even with Damian and Adrian, it's great to ask all these questions, right? Because these are things that some people know, some people don't know these things. You know, that's why we jump on here together, is to talk through these things. I mean, like I said, we have a really big team that is like writing hundreds of offers every week. So we probably see a lot more things than most people do. We're working with lots of escrow companies, title companies, attorneys. You know, we've got lots of different investors that have funds coming from multiple directions, you know. And the last thing I'll say is like what Shane brought up. The reason why we started doing fractional notes is because there was a lot of investors that had home equity lines of credit and they were lending the money out to fix and flippers, and they were supposed to be done on a certain date, and they weren't done, and that person was still making HELOC payments. And so, I just, after talking to enough investors who invested with other people, we just decided to start doing, fractional notes and prepaying the interest up front. That way we never have to worry about it. And then the spinoff is that when we were prepaying people up front, they decided to take the prepaid interest payment and reinvest into another deal. And that's how the compounded interest came about as well.
Mitch, one of the last things I want to talk about when we talk about, protection of your investment that most people don't talk about. We talk about promissory notes and we talk about mortgages and liens and all that good stuff. One thing we don't always talk about is experience. And I think Adrian was getting to that point is knowing who you're borrowing from and who you're lending to, right? It's very important to know that
Yeah.
relationship and check references, so you can go back and say, give me a list of references of people that you've borrowed money from, use private money lenders for on deals. Let me talk to them. I want to know that they're happy because having that transparency, those are people that you want to work with. It's that first time lender, or excuse me, that first time borrower who's using private money lending to do their very first deal. That's a scary situation because anything can happen in real estate and they're not experienced. They don't have the systems in place, the team in place to handle the oopsies. Mitch has a great list of video references. Cindy and I have quite a few of them on our YouTube channel. We did little video clips with
Mhm.
quite a few of our private money lenders just so that we could share them with new prospects to say, here right from the mouths of our other lenders, and feel free to reach out and contact them. And we're that transparent about it. So I think that is a great reference and a great point. And that's the last thing I'll talk about because I know Cindy's already had to go and she was chomping at the bit for us to wrap this up. So we have another one behind it. So I just want to say thanks everybody for coming. If you have any questions, if you want to talk about deal specifics, or if you want to know more topics, reach out to me. I'm traveling tomorrow, so I'm not available to do a show, but we're going to be back on Monday, 8 p.m. Eastern. Or come find us in Creative Real Estate University Facebook group. We'd love to work with you. We have deals upon deals stacked up right now for funding. Most of them are real estate. We have one business funding opportunity. We'd love to find some more private money lenders. So let's see if we can't make you some money
Thank
and
you
we
all.
all make money together.
Sounds good. Appreciate you all. Thanks for coming in.
Have
We'll
a great
see
night.
you on Monday. Thank you.